Hello, my name is J.J. Jones, and I'm the Area Ag Economist for the Southeast District of Oklahoma Cooperative Extension Service. I'm here today to talk to you about pasture, range, and forage insurance, a product offered by the Risk Management Agency of the USDA. Now, what is this product? It's basically a product to help producers minimize their losses during a drought from perennial pasture crops. These are crops that are not planted, such as Bermuda grass, fescue, stuff that's a perennial basis. This product is very similar to another product that RMA puts out called annual forage insurance. That product is meant for annually planted crops. The product we're going to talk about today is the pasture, range, and forage insurance, which is meant for perennial forage crops. Now, again, these two products are very similar in that they use the same set of data to calculate the index in the grids, no matter where they're at. So what is used is NOAA data that NOAA has went through and divided the United States into 12-mile by 12-mile grids, and then calculated a rainfall index for each one of those grids. A producer must find the grid where his pasture or his forage ground lies within, and then choose that grid for the insurance product. Now, payments are based on this grid, and the grid is calculated as average of being 100, and so the producer is going to pick a level at which he wants to insure at, and if that grid falls below that level, then they're going to receive an indemnity payment from RMA or their insurance company on the losses. Now, these payments are not based on that producer's actual loss. They could actually be in a grid and be somewhere where they didn't actually sustain as losses in the part of a grid, but the other part did. So the grid as a whole sustained a loss, and they would receive a payment. Vice versa could also happen. So producer doesn't need to think about their own losses when this product. Now, these premiums are subsidized by the RMA, but now the level of how they're subsidized depends upon the level of coverage that the producer picks. Now, there are 6 requirements a producer must think about before picking the PRF requirements. 1 is the intended use, 2, the coverage level, 3, the productivity factor, 4, insurable interests, 5, insured acres, and 6, the index intervals. And we're going to talk about each one of these in great detail. First, let's talk about the intended use and the coverage level. Basically, in this PRF product, there are 2 intended uses that a producer must choose from. First one is grazing or pasture, and the second one is hay. Now, the difference between these two is actually the value at which the insurance is calculated on. Grazing land is valued at a much less value compared to hay ground. And so a producer needs to carefully weigh these options and look at this when choosing this product. Now, hey, sir, the other thing, now when we talk about once intended use has been chosen, the next part is we've got to pick our coverage level. Our coverage level can range anywhere between 70 and 90%. And what a producer is choosing then is at the level with the index he wants to insure at. So if he insures at 90, that means he's saying that if the index drops below 90, that's where he's going to receive a payment. If he chooses a 70% level, the index would have to fall below 70 before he's going to receive an indemnity payment. Of course, if a producer chooses the 90% level, those premiums are going to be higher than the 70% level. The productivity factor. This is a very interesting tool that producers can use, and what it basically does is for each crop, like we've talked, is a county-based value. And so if a producer feels that value is either too high or too low, they can actually increase or decrease this value by changing the productivity factor. A good example is in Pawtuck County, where I work, the grazing value for this product is $13.56 an acre. If I want to insure that at a higher level, I would actually raise the productivity factor up to like 150%, and then I could increase that value up to $20.34. The county-based value for hay acreage, though, is $153 an acre. So therefore, if I thought that was too high, I could lower it and use a different lower productivity value and lower that value. Again, your premiums are going to be based on how much coverage you have, and if you have the higher coverage, those premiums are going to be a little bit higher. Insurable interest and insurable acres are pretty straightforward. The insurable interest is meant for those producers that might be having or might be sharing the crop with another producer, and they're only insuring their portion of the crop. I realize the majority of the time that this insurable interest is going to be 100%. The insurable acres RMA does not require you to insure your entire area if you want to. So if you have 1,000 acres but you only want to insure 100, you would put in 100 acres for the insurable acres, not 1,000. So it's just the number of acres that you plan to insure. Index intervals is probably the confusing portion of this product because a producer has to choose at least a minimum of 2 2-month time intervals. So these intervals cannot overlap, and they can be any time throughout the year, January through December. A producer really needs to consider the time of the year that he's worried about drought production and choose the intervals that fits his worries or his concerns as far as drought goes. Now the other part of that is you have to choose 2 of these, and you can only insure a maximum of 60% of your acreage in one of these. So you insure one, you can put 60% in one and 40% in the other, or 50-50. I've got an example listed here. Like I said, you choose the one that you want to do, and for my example in Oklahoma, for the crops, I picked June and July at 50%, and August and September at 50%, and leaves it at 100% total. I could change those and go 60-40. I could actually choose more than 2 if I wanted, but I pick the months that, like I say, you're more concerned about the drought, is what I tell producers. The deadline for this insurance is November 15th before the crop year starts. So if I want to insure a 2016 pasture crop, then I need to insure it by November 15th, 2015. So we have to think about this insurance well before we're actually going to use this. And now, the good news about this is you sign up November 15th, but the payment for this insurance is not due until September the following year. So you sign up in November, you have roughly about 11 months, 10 to 11 months before the premiums are actually due. If an indemnity payment is due to you, they're going to send you that indemnity check and subtract out the premium payments from that check. So there could be a year that you might not even pay, make a payment on this product. Now, this tool is, again, just another tool to help producers minimize their loss due to a drought. And it's like anything else, should be used in conjunction with other tools to help a producer survive a drought. If you have any further questions about pasture range and forage insurance, please contact your local county extension office.